Welcome, everybody, to the Ben and Boz Narrated PowerPoint series. We are up to Lesson 6, Inventory and Cost of Goods Sold. I'm Boz.
I'm Ben.
How are you doing today, man?
I'm feeling good. We are cruising through these things.
Sometimes it feels like it. Sometimes it doesn't.
Well, no, they're a lot of work to put together,
true.
so now it's game day,
This
man.
is the fun time when we
This
actually
is
get to
showtime.
record them. That's
Yeah.
right. All the dirty work is done. All right, man, we're going to start with an example today.
I love doing that.
Yeah, the example we're going to get into is that cost of goods sold and inventory are huge numbers for many companies. And let's look at the biggest company, which is
Walmart.
Good guess, man.
Oh, I had a slide in front of me. So
We've gone through
we're
this.
just told them how much work we do to prepare for these things.
That's
And
true,
so
that's true. You did know that. But Walmart, we've got their income statement, we've got their balance sheet, but let's highlight on the income statement their cost of sales. Now, is that $373,000?
Well, no, as you can see there, it's in millions,
millions.
So that's 373. We'd have to add 6 zeros to that.
zeros.
373
billion
Wow.
Wow.
We didn't even practice that timing. Look at that. We're just getting in the sync of this thing. Just wait till lesson 12.
That's true. That's true. And then over here on the inventory side, $43 billion worth of inventories out of a couple $100 billion of total assets. So
I would say they probably care about how those values are reported on their financial statements just because they are so large.
very, very big. So speaking of kind of these values, I kind of quizzed you on this, and obviously we've prepped this out, but I've got the Fortune 500 is a list produced by Fortune magazine. It's largely public companies, and it lists them by revenues.
Isn't it only public companies?
No, it's actually, if you've got private companies on there that have to disclose their information. I learned this last year, so there's a few private companies on there.
Cool.
But we digress.
We do.
That's
On
right.
point.
On point. So these are the biggest 10 public companies in America, at least in terms of revenues. And I made Ben guess. I said, which of these 10 companies are going to have higher compared to lower inventories, kind of as a percentage of sales? We obviously know Walmart, they have twice as many revenues as the next person. They probably are going to have the highest inventories, but more as a percentage of sales. Which ones did you kind of think were going to be the highest and the lowest and so forth?
So when I was going through, I was looking at mostly the retailers. That would be the biggest one, lower margins, right? Higher inventory that they need on hand relative to their sales at any given time. And so I actually had CVS as my number one.
Drugstores,
yeah, followed by Exxon and Walmart. I know Exxon doesn't fit that retailer profile, but I took a guess. I was wrong.
Yeah.
But I took
Oil
a guess.
and gas, yeah. So.
But do you want to show them what it was?
Yeah, sure. And then
I
on the
guess-
low side, who did you think wouldn't have very much?
I was thinking service companies. So looking at that, let's United Health Group, health insurance, right?
Yep.
It's not going to be anything.
Yep.
AT&T, maybe they sell some phones, but mostly it's the service plans that they're selling. So those were towards the bottom, and then the rest kind of just squeeze in the middle, as I guess.
So that was your prediction, and now we'll show it. Well, Walmart's $43 billion of inventory. We showed that on the previous slide. It's 8.8% of sales. ExxonMobil, we're going to focus on that final column, 7% of sales. So that was pretty high.
Number 5.
Berkshire Hathaway, that's Warren Buffett's group right there. So 6.7% of sales.
And that's a tough one because they're technically an insurance company, but they take all those premiums, invest in other companies.
Well, they got their foundations in insurance. They own like everything.
Exactly. That's what they take everything.
They've had big shares in a lot of non-insurance companies as well.
That's
a lot. So
Coca-Cola
is one of the big ones. Yep, definitely.
That's what drives up the inventory as a percentage of sales.
Yep, exactly. Now Apple all the way down to only 2% of sales. So you think of like iTunes, right, as an example, and they just don't need a lot of inventory for iTunes.
iCloud, another service they provide. And
iPhones, there is an inventory cost with that, but it's just not going to be as big as compared to sales.
It's a pretty high margin on their phones, so inventory low relative to that.
UHG you said was going to be low, and let's see if Ben is right. 0.
And that's another insurer, right? Berkshire Hathaway is more property and casualty, but United does health insurance. They don't have those extra investments like Berkshire does.
Yep, so they're all services. McKesson, they're more health products, so that's why they actually have a pretty significant inventory percentage there. CVS, I suppose, you look at those shelves, right? You walk into a CVS, those shelves are stocked.
Not just a pharmacy. They got a lot of retail goods as well.
Yep. Amazon also pretty high. Low margins, huh? Low margins and
Low
everything,
margins, high turnover.
Yep. AT&T, you predicted them to be low, and they were low, Ben. Congratulations, man.
Yes, woohoo!
So, yeah,
That's a victory. I'll take it.
Yeah, the cell phone plans, right? They don't need inventory on those. And then General Motors, I probably would have picked General Motors a little higher than that. That's maybe one of the ones that surprised me that was behind a few others, but I don't know. That's why you do it. You just learn a little bit.
Yeah, trying to build up your general knowledge base here. Now that.
Yep, but the manufacturers and retailers are generally what we're seeing that are having the higher inventory levels.
Yeah,
so
service companies on the low end then.
Yep, definitely. All right, well, let's get into some nitty-gritty a little bit. So the overview here.
The good stuff, you mean?
Well, I don't know.
Let's break out the good stuff.
But the students always tell us they want real-world examples, so they'd probably like slides just like that last one the whole time. But you got to teach some nitty-gritties. How do we get that information on those slides, right? So an overview, we're going to get into some definitions related to inventories. We're going to talk about the 3 main inventory costing methods, the impact on the financials, and then also understand the rationale behind why you select one inventory costing method versus another.
I'm excited for that last one.
The rationale?
Yeah, it's the who cares question.
That's true.
Right?
Well,
we can put all the stuff on paper.
When it comes there, if I start to talk about it, make sure you interrupt me. So you take that.
Hey, as a teaser, everyone, we got a tax slide coming up. Woo! That's going to be for us.
You don't take that one, man.
I'm going to try and take it now just to see what happens with it.
Yeah, good luck. Good luck. All right, so definitions. When I think inventory, I just think stuff a company holds it's going to sell, right? A little bit more formally, goods, products owned by a company held for sale.
Hey, you got it right.
Yeah.
Way to go, boss.
That's right. Merchandisers, when I think of a merchandiser, those are companies that are going to buy and sell finished products. So examples of those, Ben, of like real-life companies?
Walmart, Target, Best Buy. Exactly. This would be
Amazon.
Yeah, our honeybee business. My wife and I, we're a manufacturer, right? We produce the lip balm, the hand lotion bars, any of the wax products. Then we sell those to Coborn's or whoever in the area.
Yep, Coborn's.
That's the
local grocery store right here. So
I forgot we're going international with these videos.
Well, we are, but that's why we just say local grocery store. They can identify it with their own local grocery store.
Maybe Coborn's will pay us.
maybe. I'd like some. I don't know. What would I want from a grocery store? I want free bacon.
I want nacho cheese Doritos.
Nacho cheese Doritos, all right.
For life.
That's for life, wow. So merchandise inventory, that's the name that's given to the inventory for the merchandisers. And then we have manufacturers. Those are the companies that are going to produce the goods. So when you think of manufacturers, Ben, examples of those?
General Mills is the biggest one that pops up.
That's a Minneapolis headquartered company that makes cereal. So take
cereal,
the grains
granola bars, soups. Getting into their healthy snacks, dog food now, or pet food, I should say.
Wow.
Yeah. Well, a lot of manufacturing there.
So General Mills, General Motors, one of the big 10 companies, so car company.
Kellogg.
Yep, Kellogg's.
Ford.
Ford.
Tesla.
We could just keep going on and on.
I think they get the idea, though, right?
Pepsi, they make your Doritos, if you want.
I appreciate that. Yeah. Frito-Lays.
Totally. So, we were going to say something?
Well, yeah, I was going to transition out of manufacturers and say it's not as easy as merchandisers who can just buy the finished good and sell it. Not to say that merchandise is an easy business, but manufacturers, they have to purchase the raw materials. Then they put them into work in process, meaning you buy, say if you're General Mills, you buy the grain from farmers. You add in all the ingredients together. That's the raw materials that are going to be processed. You have some labor involved in the process to do the mixing itself. And then you got to cover your overhead. So there's a few more costs involved that really in more of like a managerial type accounting course.
The next
you'll
course,
get into that.
Yep. This is kind of the intro accounting course. In the second accounting course, you'd see that. The focus of this course is more merchandisers. But all right, well, inventory flows. When we think about that, inventory is debited when it is purchased, and then usually the credit goes to cash or accounts payable. So again, debit to inventory, credit to cash or accounts payable.
That's nice. The journal entries, as we'll see, journal entries aren't the most difficult part of this chapter. It's more about trying to find what type of inventory costing method we're going to use. That's where it gets a little complicated.
Good point. So if you hate journal entries, this is the only slide where we really get into them. So if you hate journal entries, don't tune out. So
stick with us.
Stick with us
in this episode.
That's right. And then when your inventory is sold, you credit the inventory. The debit is usually to a cost of goods sold then. So again, debit to cost of goods sold, credit to inventory. Those are pretty much the two journal entries that we have in this chapter. So,
not too bad.
No, not
Are they
bad.
always going to be for $100?
Always.
All right.
Okay, maybe
Good
not.
to know. Good to
So,
know.
Yeah. So inventory systems. I don't know. Do you want to say anything about perpetual versus periodic?
I do. So we have two
do?
main types of inventory systems: perpetual and periodic. So perpetual, these are the ones that these big companies, usually merchandisers, high turnover type businesses, usually use perpetual inventory systems because that allows them to know every single time a sale is made, automatically updates the inventory system. So these are called point of sale (POS) systems. Again, grocery stores is really what I think of for perpetual. They need to know what goods are leaving the shelf so they can restock. They don't run out and lose out on potential sales.
Do they ever need to count their inventory then if it's always up to date?
I feel like they still occur at least once per year to compare expected and actual levels. Don't you think?
I think they probably should. So
it's right there in the slide.
Yeah,
what do you know?
It is a shocker, right?
Yeah. So
why could they be different? I mean, you're an auditor, so I mean, I think you've actually done some inventory counts. I was a tax guy, so I didn't. But why would you, if you have this perpetual up-to-date inventory system, why did you guys have to go out and count it?
A few different reasons. The most obvious one you think of is called shrinkage, where people tend to steal things from inventory. That happens, but other items also happen probably more often, where say we're doing General Mills and they are driving through with the forklift and they accidentally hit a bunch of boxes of cereal. Things get broken in the warehouses, or goods go bad and they spoil, right? Where things happen, but maybe that's not communicated to the people that are recording. So it's not going to run through every time a sale is made, but they have some other adjustments for that.
Yeah.
Also, sometimes things get lost, right? You're talking about multi-billion-dollar companies moving things from warehouses all the time. So
Yep.
And it happens.
We got to record inventory accurately on the balance sheet. So if we think our inventory is $100, but we go through and count it and it's only 95, we got to show that adjustment to get down to 95 to report our financial statements accurately.
Absolutely.
So now the periodic system, the next one, go ahead on this one.
Yeah, so periodic then, it basically only relies on the inventory counts to know what your ending inventory is. You don't worry about tracking every single sale, reducing your inventory. You would think, hey, with technology systems, perpetual is, much easier, much more accurate, real-time information, and that's absolutely true, but perpetual is also kind of expensive. So for smaller businesses like the Honeybee business or Vaz's selling his books, it just makes more sense for us to do a periodic system.
I don't update it online every time, so we've got to do our counts to figure out what our inventory is. So
there we go.
Totally.
Perpetual versus periodic.
Yeah. So inventory and the cost of goods sold formula here. This is just a critical formula, remember. Nothing too exciting, but it's just you take your beginning inventory, you add
What do you mean nothing too exciting?
It's just there's no numbers on here.
This is exciting.
This is exciting. It's more exciting when we add numbers. I'm glad you get excited by this, but add in the purchases.
Once you know this, you can add in any numbers anywhere. You're good.
That's a great point.
I'm going to stop cutting you off. You go ahead and do your boring explanation. That's fine.
My boring explanation. Equals goods available for sale minus ending inventory equals cost of goods sold.
Hey, that's what you get in other PowerPoint series.
That's right. All right, but this framework we're going to be using throughout the next much more entertaining slides. I mean, this is straightforward, but inventory can be computed many different ways. So the inventory methods, so GAAP, generally accepted accounting principles, that requires that a company choose and stick to an inventory valuation or costing method. So there's should we call them the big three methods?
The big three.
The big three.
And then plus one.
Plus one. Big three plus one. So FIFO, first in, first out. LIFO, last in, first out. Weighted average, those are probably the three most common, and then we're going to see a less common one, specific identification.
Hey, that's a nice little gap on the slide there to kind of make it stand out, don't you think?
Ben put that gap in there. I created the slides. Ben put the gap. He wants to point that out.
Creative genius at work.
You don't hear that with a CPA too often.
Yeah,
or if you do, it's usually a bad thing.
If it was that genius, you wouldn't have to tell people about it. So it's probably not.
That's good. So, all right. So what we're going to work with here, we need a base set of facts. All right. So we're going to say that we have a company that starts with 100 units. And it paid $20 per unit, so they have $2,000 worth of units at the start of the year. They purchase some goods. They purchase 110 units at $21 a unit, so that stock of goods is $2,310. They make another purchase of 120 units at $22 a unit, so that clump of goods is $2,640. And then we would refer to that as they have goods available for sale of 330 units. The total is $6,950.
And you can see our formula at work on the left side where we start with beginning plus the purchases gives us our goods available for sale.
And an important thing, I mean, a company never has all these at one point in time. They purchase and sell throughout the year. But this is, you'll kind of see the framework and the model with how it works. And then we look and we see that this sample company sold 200 units at $40 a unit, so their sales were $8,000. So what we know is that this company had 130 units in ending inventory. And just to repeat on that, it's not like they accumulated 330 and then sold 200 to get down to the 130. These were kind of all coming and going throughout the year.
Did you forget to do ending inventory per unit in dollars, Buzz?
Oh, there's a gap there, isn't there? Do you think I forgot it?
Yes.
Yes, you
yes,
think
I do. Not
it.
to throw you under the bus
That's
here,
right.
but I think you forgot it.
I actually did not forget it, and the reason I didn't put it in there is because we have to figure out how to compute that using one of our three main inventory costing methods.
Oh.
Yeah, so let's go to that first one and compute what is that $130 worth. So the first part here is the same base facts that we just had. And we're going to say that we have ending inventory of 130 units. But here we're using first in, first out. So when we look at that one, that means that the beginning 100 units, we're just assuming that those are the first that are sold. All right?
And you say assuming. So
yeah, good point.
This isn't like the actual physical flow of goods. A typical company, it probably would be those first 100 in are the first ones that they get rid of, just so things aren't sitting on the shelves and spoiling and everything like that. And so, but when we're looking at FIFO and LIFO and weighted average, we're just doing the accounting side. This is not the physical flow of goods.
Yep, this is all just accounting, not physical, not reality here. So we have ending inventory of 130 units, and we're saying if first in is first out, that means the last stuff is still sitting in ending inventory. So we got to account for these 130 units. So we go to kind of the last purchase. So we take the 120 from our last purchase at $22 a unit, and then we add in the 10. We add in 10 more units because we got to get to 130. So now we go to kind of our previous tranche. We take 10. Of
Good
these 100
word.
Tranche. So before I used clump, that's a tranche is a much better word than clump.
Yes.
So
technical.
That's right. So 10 comes from this the purchase one tranche at $21 a unit. So what we're going to say is that our ending inventory is 130 units, $2,850. And then we subtract off in our cost of goods sold. Well, we knew we sold 200 units. But here's how we compute it. $4,100, that's the $6,950 minus the $2,850. That's what gives us the $4,100.
All right.
You'd asked me why I didn't, I could have, actually computed the 200 first. Basically first in, first out. Okay, well, we sold, these 100, and then we sold 100 of these. And I could have computed cost of goods sold, actually, by tranche, and then backed into ending inventory. Ben said, why didn't you do that? The answer that I gave is normally a company is not just going to have kind of three tranches here. They're going to have a lot of different purchases throughout the year, and the ending inventory is actually going to be pretty small compared to actually the number of sales that they had. So real life scenario, it's more efficient to compute the ending inventory as compared to compute what you actually sold.
Could we set up a computer program to do this for us?
Gosh, I would hope we would. So
tune into our Excel video series to see how that works.
That's right. We have one coming. So LIFO, do you want to talk about
I was going to say,
one?
can I take LIFO?
Yes, please.
All right. So on the LIFO system, we're in the last one in is the first one out, meaning that purchase number 2 that you see right over here for 120. When we make our sale in the next little bit here, next part of the slide, clump of the slide, you might say.
Grouping.
The next grouping on the slide, when we make our sale, that 120 is going to be the one that goes away first. So when we use a LIFO method and we have ending inventory of 130, we're going to say our oldest units, those are the ones that we have on hand. So we're going to take 100 from the beginning at $20 per unit. And then to get to my 130 minus 100 means 30 more units to go. So we have 30 units from purchase 1 at $21 per unit left over. And if we add that together, you can see we've accounted for all of our 130 units right here. And our ending inventory value is $2,630. And that is more of our older stuff. Again, not actual older stuff, not just moldy cheese sitting on the shelves. It's just for accounting purposes, we say the older ones are still in our ending inventory.
Yep, exactly.
So then cost of goods sold, same method as before. Take our goods available. Remember, goods available is the same in all of these scenarios that we're doing. Goods available minus our ending to get us cost of goods sold of $4,320.
All right, now we go on to the next method, weighted average. Again, your top part of your slide here is exactly the same. But what you do here is you need to come up with the weighted average price per unit of what you paid for them. And we don't do a simple average, all right? So we don't just look at the three of these and say the average is 21. That's why I created a different number of units, if you're wondering, Ben. So because it made it work from a weighted average standpoint.
You know, I wasn't wondering, but
Yep.
I trust you.
That's right. So, and I mean, so when we do a weighted average, we have more units at the higher price, so we know it's going to be a little bit more than $21 a unit. So we do goods available for sale in dollars, the $69.50. Goods available for sale in units, the $330. And now we have $21 and 6.0606 cents.
That is a great number, boss. That's
You wondering why I did that?
A little bit, yeah.
Yeah. It's so that when we do the numbers down below it all ties out as opposed to having some rounding issues. So that's why I did that.
That's a smart move.
Yeah, well,
did you do mental
you know what would have been really smart is to actually have just come up with an example where it didn't round off so oddly. But I had these slides done.
I wasn't going to be critical.
You weren't going to be critical,
like that,
not this time. So.
Yeah, not when we're live.
That's right. So I tried to do the numbers below without going to the final 06, and then they didn't add up. So, but anyway, ending inventory. This one's easy. This one should be the easiest. You just do this computation. Ending inventory, because we sold 200, we have 130 in ending inventory. Multiply it by the 210606. There's your ending inventory in dollars. Cost of goods sold, we sold 200 units. Multiply it by the 210606. There is your cost of goods sold in dollars.
You know, Boz, I've been following pretty closely, given that I'm a part of this. It feels right now like we're just spitting out numbers.
Yeah, so it's almost like you want to tie it together and
summarize
it somehow.
Summary. I need a summary.
Let's go to the summary slide.
Oh, nice.
Woo!
Bonus. I like that.
That's right. You were excited. You want to take this one?
Yeah, sure. Why not? This is the kind of why do we care, right? It brings it all together piece of it. And so the first line we have here is sales. And so sales under every method is going to be the same. Nothing has changed, right? We've always sold, I think it's 200 units and gotten
$40 a unit.
At $40 a unit, gotten $8,000 for it. Next up, you can see cost of goods sold. That is where we are seeing the differences. FIFO has our lowest cost of goods sold because we're selling the oldest goods and our prices were the lowest back in the day. That usually happens. So they have the lowest cost of goods sold. LIFO is the opposite. We're selling the most recent goods. The most recent ones were the expensive ones. So LIFO has the highest cost of goods sold, and weighted average, like you'd expect, is in the middle because it's a balance between the two. When you're working through these, always check. Make sure weighted average is, in fact, in between FIFO and LIFO. And if it's not, then probably something's messed up.
Kind of a good check figure, basically. I was going to say that, and I was pretty proud of myself, and then you stole it.
Oh,
so it's okay.
You're impressive, boss. You're good.
You'll pat my back, thank you. So, give me that was a weak pat. Anyway, go ahead.
So then, obviously, that rolls into gross margin and ending inventory. And so FIFO has our highest ending inventory. LIFO is the lowest, which would make sense when you consider cost of goods sold and ending inventory. And weighted average, like you would think, is right in the middle.
Yeah. So an important note here. So a company just has to choose one of these. Okay, a company makes a choice, and it generally has to stick with it. I mean, it can change it, but that's beyond the scope of this course. And this choice will result in financial statements looking different, but this is so critical to understand. This does not affect the economic value of the company. Again, accounting profits are not equal to economic value. The economic value is going to be the same under each approach. Under each approach, the company is going to have sold $8,000 worth of goods. We assume they sold them for cash. That's $8,000 of cash that they're going to have received. And under each approach, they're going to have 130 units on hand. And those units on hand are worth whatever customers will pay for them at the time. This is just an accounting value. This does not mean if you use FIFO that your units are worth more. All right, so your units are worth whatever your customers will pay for them, regardless of how your accounting has worked for them. So that's a tough concept.
It is. It is a tough concept. And in a little bit later slide, we're going to get back into it to talk about what type of companies would prefer FIFO versus LIFO and bring in the tax consideration of everything too. So stay tuned. We're going to get to, I don't want to jump the gun. But
it's kind of like if you bought 2 bottles of water and maybe one of them you got as part of a big pack of water at Costco. They cost like 7.5 cents a piece if you get them in a big pack. And then maybe another one you bought them at a gas station for $1. All right, so you got 1 bottle of water that cost you 7.5 cents, another that cost you $1. The reality is you have 1 bottle of water. All right.
We have 2 bottles of water.
Well, okay. You have 2 bottles of water. One of them is not more valuable than the other, right? Wouldn't be like I'd say, hey, Ben, do you want to buy one of these bottles of water? The price you would pay me is not dictated by how much I paid for them, right? So anyway, we go on to the next slide. Trends. When inventory prices are rising, FIFO is going to have the highest inventory, lowest COGS, and highest gross margin.
So you look the best.
You look the best under FIFO. Yep, definitely. So high inventory equals high margins. And then when prices are decreasing, LIFO is going to, as Ben would say, look the best.
Yeah, on paper, you want that higher gross margin, which everything else held constant, that's going to trickle down into a higher earnings per share, which a lot of investors will look into and track over time, as you'll learn in Lesson 12.
Yep. So we go on. And so specific identification, if we want to talk about this method for a moment.
So this is just our slightly different method. It is used, but it's not, I guess, as common. So,
only in selected industries.
Yeah, very specific products. When we think of some examples of selected industries, jewelers, where you have like diamonds, for example, 5 C's, right, on your diamonds are going to have very different values for each one. So each ring that you're selling or necklace or whatever is going to have a very different value.
You just said 5 C's. Half of our audience is college guys who have no idea what that is.
Gentlemen, let me go ahead and educate you. 5 C's.
Cut, carrot, clarity, and something else.
Something else. Yeah. Cut, carrot, and clarity. I was hoping you'd pick up the other ones. All right. Construction companies, right? Think if you're building a home or any sort of building, it's going to be different, right? Probably have its own specific product. Any really custom product company is going to maybe use specific identification. So just as a little example here, jeweler has 3 rings. One costs $2,000, one costs $3,500, one costs $5,200, and they sell the ring for $3,500. We're not going to use like a FIFO, LIFO weighted average method here. We're just going to pick, that was the ring that cost $3,500. So they're going to debit cost of goods sold and credit inventory.
Yeah, technically maybe they could try to use FIFO or LIFO, but I think the users of the financials would just say, come on, that doesn't make sense. You can really use specific identification here. And we can go on to lower of cost or market. This is a little bit more of an advanced topic, so we'll hit this one a little more quickly. But if your inventory has declined in value, you may need to, what we refer to it as, is write it down.
It's usually not a good thing.
No, you don't like your inventory to decline in value. So companies should record the inventory at the lower of what they paid for it, and that's what we normally do.
That's like the default. Don't change that.
Yep. Or what's called the net realizable value. Selling price less cost to sell. For this video, it's just what it's declined in value to.
Basically, if you're not going to be able to recover the cost that you paid for it, then you need to write it down.
Exactly. So Best Buy purchases a model of TVs from Sony for $500 a piece. Maybe a year later they still have those TVs on hand, but they could only sell them for $400 because no one wants old model TVs anymore. In that situation, the net realizable value is only $400. They paid $500. They've got to write down those 100 TVs by $100 a piece. So they've got to do a $10,000 write down. And then here is the journal entry. It's kind of the same journal entry as like when you sold the stuff, but here you're just writing it down instead.
Yeah, so basically companies are forced to take more expense right away as a result of a write-down, which they're never going to be super excited to do.
Exactly. So sometimes, Ben, we go every other slide to keep each other fresh.
I'm going to go ahead and take Dib's next
slide.
slide.
You are not going to take the next slide because the next slide is tax considerations.
I just want to hammer through this one, move on to the next. But
that's right. So I do. I'm a tax guy.
Keep in mind the timing of this one. We don't have an hour.
We have 1 more hour to go. So
on this slide.
That's right. So companies can choose different accounting methods actually for tax purposes as compared to book purposes. So some companies will use FIFO for both books and tax. You can choose something different for tax, actually, subject to some limitations. So in a period of inflation, companies would show lower profits and pay less in taxes by using LIFO for tax. So a lot of companies, assuming they're in industries that have inflation, they do want to use LIFO for tax. The limitation is that if you use LIFO for tax, you've also got to use it for books. So what that does then as a public company is say, well, I like a low tax bill, but I also like high financial statement profits. But you can't have both. In a period of inflation, you cannot, what you would love to do is choose FIFO for books and LIFO for tax. You cannot do that. They don't allow you to do it. So you got to choose whether to keep profits low, which will give you a low tax bill, or keep financial statement profits high, which will give you then a higher tax bill. Private companies, if they don't issue financial statements, then they'll often choose LIFO because you'll get a lower tax bill. You'll get some tax benefits. So are we all done with the presentation?
Bonus slide! All right, so this
like
one...
the lamest bonus slide ever. So.
Whoa, it's not a lame bonus slide. So this brings back to the real-world examples. Why do you care? Companies, if they do end up using LIFO, they have to disclose what's called the LIFO reserve. And so this is saying if you would have used FIFO, what would your inventory have been? So this helps with comparability of companies. If analysts want to look at it, look at the differences. You could, in theory, do a partial adjustment on your income statement as well, where cost of goods sold would have been different. And it's not just in 1 year cost of goods sold would have been different, but over time, this LIFO reserve accumulates. And so here we have General Mills.
Did you still work on that account? Because you knew this one. You told me when I was prepping these slides to find General Mills.
So not only did I audit General Mills, I audited inventory on General Mills. So, yeah, man, I've been counting Cheerios in Buffalo, New York, counting Gushers in Cedar Rapids, Iowa.
I don't know what a Gusher is. But
really?
Yeah.
It's the greatest fruit snack of all time.
Ooh, let's get some. I'm hungry. It's dinner time.
Highly recommend it. All right, so they report an inventory of $1.6 billion in 2018. Billion with a B. Then in their footnotes, so the notes to the financial statements, they show you how they came up with that $1.6 billion. And so they had raw materials, finished goods, some grain, and then this little piece right here, excess of FIFO over LIFO. Basically, if they had used FIFO, they would have bumped up their inventory cost by $213 million.
It's a pretty advanced topic overall, but this is a little teaser. If you go forward with accounting, you'll dig into this one a little bit more.
If you go and audit General Mills, you know what's happening.
Absolutely. All right, key takeaways from this one. We're going to wrap it up here. So inventory, you debit it when you purchase it. You credit it when you sell it. COGS is debited when the inventory is sold. The main inventory costing methods, FIFO, LIFO, and weighted average. Under periods of inflation, FIFO is going to give you the lowest cost of goods sold and therefore the highest profit, also the highest tax bill. Your choice of your inventory method, it does not conform to the actual flow of goods, and it also should not affect the value of the company. But we have to choose how to report our inventory and our cost of goods sold. Any parting words, Ben, as we say goodbye today?
No. Thanks for tuning in.
Thanks for tuning in, and we will see you with next time, Lesson 7, where we're going to get into property, plant, equipment, and depreciation. See you next time, everyone.
Thanks for tuning in, everybody.
Cheers.